Everybody's filing in. All right. Hello, everybody. Thanks so much for joining us this afternoon. We're going to get started here in about 2 minutes. We're just going to let everybody file in. See everybody's kind of slowly joining the Zoom room. So appreciate you being on time. We're probably going to get started here around 1:02. So we're excited to be with you here in this afternoon in San Antonio. I see people are continuing to file in. So let's give us about another 60 seconds and we're going to get rolling. I see most people are jumping in right now. Awesome. So many familiar names. Appreciate you taking the time to join us. I'll go ahead and get started with some housekeeping items again. Appreciate you taking the time to join us this afternoon. Really quickly, my name is Zach Holcomb. If you haven't had the opportunity yet to meet me, I joined the Reliance family about a year ago on the marketing team, helping run point on our live experiences, events, and now these online webinars. Today, we're going to have a really short session on navigating market volatility and what you should be thinking about during these uncertain and crazy times. We anticipate this session is only going to last around no more than 30 minutes max, so we're going to let you get back to your day relatively quickly. A couple things I want to touch base on before we start. At the end of the presentation, we're going to be offering you an opportunity to engage and chat with our team. If you're a current client and already a part of the Reliance Financial Partners family and you have some questions about the material presented today, we're going to offer you the opportunity to have a conversation with us or answer any questions that may come up. But if you're not currently working with Reliance Financial Partners and you'd like maybe a second opinion on your situation, maybe you're looking to work with an advisor for the first time, or you just want to explore, working with somebody new, or maybe just have a simple question, you're also going to have an opportunity to explore that as well. But before I pass over the baton, today's presenter, Grace Suchi, financial advisor here at Reliance, I want to share a little background about her career. We're fortunate enough to have Grace here, a part of the Reliance family. She has over 30 years of experience spanning from financial service companies and elder law. She brings a really deep, well-rounded perspective from her time working at TD Bank, JP Morgan Chase, Hurley Elder Care Law, and now Reliance, where she helps many of our clients navigate uncertainty with clarity and confidence. She is thrilled to be presenting with us today, and I think Grace has given me the signal that she's ready to go. Grace, ready to take it over?
Yep. Thank you so much, Zach. And hello, everybody. So I'm so glad that everyone is here. Today, we are going to be talking about navigating market volatility and how effective planning can help do that. You may have heard in 2025, we've witnessed significant market fluctuations. And we thought that it would be good to proactively reach out and just talk to y'all about that and kind of explain, some of the safeguards that can be put in place for you. So before I get going into the presentation, for those of you, I know we have tons of clients on here and I'm so excited about that. I just wanted, for those who are not clients, just to tell you briefly about us. So the name of our firm is Reliance Financial Partners. The business was founded by Dana Dunkelberger in 2012, and we are independent financial professionals, which means that we work with a variety of firms and companies. We are not beholden to like Edward Jones or Charles Schwab. We work for you, basically, and we are fiduciaries who represent what is in the best interest of our clients. This is our team who are dedicated to serve and answer questions. So let's start with a question, though. Are you worried about the current state of the market? Now, Zach here taught me how to do a poll, and I'm going to go ahead and poll the audience. So hopefully you see a poll showing up on your screen there. Go ahead and vote if you'd like.
What are our results looking like?
Like nothing. Zach, did I do it wrong?
I do see some people in the chat in the Q&A saying yes, they are concerned about the market. If you
Okay.
saying no, not so much. We can try the poll one more time. More polls and then hit launch.
I mean, it's up on my screen.
I think the resounding response that we're seeing in the chat here is, yes, we do have some concerns about the market. So I think the consensus is that
We'll go with that. All right. Zach set me up with the poll, everybody. All right. So the first graphic I wanted to share was just a kind of picture of what volatility has looked like since 1990. So you can see lots of ups and downs here, right? So the reason why I'm showing you this is not to say, oh, everyone should be totally comfortable and cool with volatility. It's definitely scary, and I understand that. But it is normal throughout the years. So some of the key factors right now that we're seeing is there's been some market turbulence due to some tariffs and trade policies. And because of that, the S&P and the NASDAQ, major indexes, have experienced some significant declines in 2025. We're seeing gold prices have surged to historic highs. And that kind of indicates that investors are seeking safe haven for their assets with the economic uncertainty. Some of the investor sentiment is leaning towards pessimistic, and the market is a very emotional thing. So believe it or not, that can have an impact on what's going on today. We're also seeing some interest rate fluctuations. The Federal Reserve has acknowledged market volatility, but has not made major changes in interest rates at this point. So that's kind of some of the what's going on right now and what's gone on in the past with market volatility. So for those that are retired, this can have a tremendous impact and can be even more frightening. Retirement savings can be affected by market downturns, of course. And retirees do not have as much time to recover from losses. So for someone like me, I'm in my 40s, I don't love looking at my account dropping each day, it seems, lately. But I do realize that I have another 20 to 30 years. Oh God, I'm gonna cry, until I get to retire. So I know that I have time to make that back. Somebody who's retiring next year, that's going to be particularly scary because you may not have the time to recover to be able to execute on your plans. The anxiety comes from being worried about your financial stability and the impact it's going to have on your lifestyle. So when you stop working and you're retired, you depend on your investments to help you maintain the lifestyle that you had when you're working, hopefully. Or even better lifestyle, traveling and doing things that you didn't get to do while you were working. So there's a need for strategies that prioritize capital preservation. And that's the value of planning when you're moving into retirement. So one thing that we are pretty passionate about here is low volatility portfolios. So yes, of course, everyone loves a more volatile portfolio when it's up 30%. But when it's down 30%, it sometimes takes a little longer to get back to where it was. So when you're invested in a low volatility portfolio, you're going to have reduced exposure to market swings, steadier returns over time. Your dips aren't as steep, so your portfolio doesn't have to work as hard to recover. And that's really the important part of it. This can give an enhanced peace of mind for those who are retired. That way they don't have to see those dramatic swings. So some things that you might find in a low volatility portfolio would be dividend paying stocks, investing in companies with a strong balance sheet and consistent earnings over time. We want to look at high quality bonds. We're not going for the junk bonds, even though the interest rate may be higher. We want to look at balanced ETFs. So that means ETFs that have exposure to a lot of variety. And for anybody who is not familiar, an ETF is similar to a mutual fund, but it's traded on the open market. We use ETFs over mutual funds a lot because the fees tend to be lower. So we like it, and it kind of serves the same purpose. It's like a basket of stocks. We also really like buffered strategies. This is where you might have some exposure to an index, but you have some downside protection, 10%, 20%, 30%. You may not be able to get the top of the index. So if, for example, if you're in an S&P buffered strategy, you may, if the S&P is up, 15%, you may only get 9 or 10, but you might have 10, 20, 30% downside protection. So we like to use those to give a little to hedge against losses as well. Another term that you hear a lot over when we're talking about investing and protecting a portfolio is diversification. So diversification is just spreading investments over various asset classes to mitigate risk. So that means you're essentially not putting all of your eggs in one basket and trying to kind of spread things out so that you don't have too much exposure in one area. So the advantages of this is it will protect against poor performance in any single investment. So for example, if you take your whole portfolio and you put it in technology stocks, and then technology takes a big hit, then your whole portfolio is going to take a hit. If you've got it well, aligned over several different asset classes, then, if technology goes down, maybe that's only representing like 2% of your portfolio. It also gives you opportunities for growth in different market sectors. So some market sectors do better than others when times are tough, and you want to make sure that you have exposure to a lot of different things. So the way that we do that is we look at using a mix of stocks, bonds, and alternative assets. That could be, REITs, or, looking at even mixing in some annuities and things of that nature as we're looking at your overall plan. We also look at domestic and international investments as well. So we're not beholden to anything. We want to make sure that we have you well diversified. The other piece of it, and the fundamental strategy of our asset allocation plans, is to make sure that every dollar has a purpose in your plan. So we segregate these dollars. If somebody, some of you who have met with me may have heard me talk about safety, income, and growth. And so when I'm looking at someone's overall portfolio, I really want to know what do these particular dollars do to address these various items in your plan. So I'm going to get into a little more as far as what each of these buckets kind of represent here. So your safety bucket, that's going to be your money that you can get to immediately. It's going to be money that is not going to go down in market value, not have exposure. That would be certificates of deposit, treasuries, fixed annuities, and high yield savings accounts. So these are safe investments where you typically cannot lose money. And they are great to use and to have for an emergency fund. I do recommend that people have between 6 to 12 months worth of expenses set aside for emergencies that they can access quickly. And so again, our considerations with the safety bucket is, can you access this? Does it have liquidity? Will it work as your emergency fund? You do want to understand interest rate environments. So for example, if you look at CD rates right now, they've been fantastic, right? That might not always be the case. I know it hasn't always been the case. So when I was in banking for many, many years, I can recall people coming in with their CD maturing, and I'd say, "Oh, I've got a great rate for you. How's 1%?" That's certainly not the case today, but it wasn't too long ago where those were good CD rates. So you just have to make sure if you have a lot of exposure there and you're using those for income, that you are aware that the interest rates can change. we also look to evaluate that they act as insurance and guarantees for people as well. So this is your safety bucket. The number one concern that people have in retirement is income, because they're no longer working and they need to generate this. So how does a retiree generate income? That would be from Social Security or pension, of course. You can also derive income from bond interest and things of that nature. Some people have a lot of properties and they're relying on real estate for income, rental income. And then some people will use annuities for lifetime income. So some of the considerations here would be that you're looking for guaranteed income sources to protect your lifestyle. So when we're doing that and when we're mathematically trying to figure out the best way to go, we want to have a deep understanding of your expenses in retirement. Because what we're doing is we're trying to figure out, how are we going to make sure you maintain your lifestyle? And expenses are a part of that, right? So many times we'll ask you what you think your expenses are, but then we may even give you some homework and say, dial this down for me, make it a little more, let's do a little research and see what our actual expenses for 3 months or 6 months have been. And so many people come back to me and they say, oh my God, why did you make me do that? Or they might say, oh, that was better than I thought. But the more accurate we can be, the better we can be at making sure that your lifestyle is maintained. This is something that is very important in planning. But also the kind of fun part about it, and even though this isn't an expense, is we also ask you to kind of make your dream list as well. So as you retire, what do you want to put aside for your annual travel budget? Do you have any major purchases planned? Are you going to be buying a second home? Do you want to give money to your family or to charity? It's a judgment-free zone. I want to make sure that I know so I can make sure I help your dreams come true for you. And if it's not realistic, I will be the first to tell you, basically, and figure out a plan as to how we can get there. Now with income, there's also taxes. So we also want to find the most tax efficient way to generate income, because you don't want to rely on this income and then have to pay more of it than you need to for taxes. Third bucket is growth. So growth is going to come from your stocks, your mutual funds, and your ETFs, hopefully, and over time, basically. Now, when the market is down like it is right now, this is an opportunity for growth. So people in our industry, although, some might say, oh, rough time to be a financial advisor, I actually look at it as the opposite. I think it's a great time to be a financial advisor, because we can now proactively reach out to people to discuss strategy. People in our business shouldn't be hiding under the covers, avoiding calls. We need to look at each portfolio and figure out, okay, is now a good time to actually buy? Is now a good time to shift our strategy? So I love the problem solving aspect of this. And so, but growth is historically what will come from these investments. So some of the key considerations when we're talking about growth is that it's a long-term landscape. So if somebody is saying, okay, I'm retiring in 3 months, put all my money in stocks, aggressive stocks, we're going to say, okay, hold on. And we're really going to dial back into the planning piece of it. You will need some long-term funds set aside for growth, but we want to make sure that everything's segregated correctly. Typically, your growth options will help outpace inflation. So if you're in the safety and income specter with all of your money, you may not have the interest rates and growth to be able to outpace inflation over time. And that's something that we'll look at and educate you on as we're doing planning. We also want to make sure that we manage these assets in a tax efficient manner. So for example, if you're needing to take money right now and the market is down, there are some schools of thought that will say, okay, well, I don't want to sell right now because the market is down. And that may be true. But if we can help you from a tax perspective by realizing some losses, this is how deep we have to go into our decision making when we are looking at people's portfolios. The great thing about growth is that you can have more fun when the market is doing well. So your portfolio is up 20%, 10%, whatever. Let's go take an extra vacation. So I love to tell people that they should spend more money and figure out how they're going to do it, basically, and send pictures. And then if you have less, when you will have less stress with these growth options, when you have market volatility, when you have a plan. So if you know that your lifestyle is protected, if you know that you have your emergency fund and it's protected, even though you may not look at these and say, oh gosh, the market's down, I'm so excited right now about that. You don't have to worry. You don't have to say, oh, I'm going to go back to work. We don't want that for anybody. And so that's kind of the importance of the planning that we do. So when we're looking at planning, we're looking at really 5 different areas, and this is called our 5 worlds. So the 5 worlds consist of course, investments, and that's what we're talking about here. But investments are just a tiny sliver of someone's overall financial plan. Of course, you need them, and of course, we do them, and they're going to help drive a lot of these things. But we have to look at other things as well. So we have also income, which we were just talking about. That is what's going to give you the funds to maintain your lifestyle. We need to figure out how we're going to derive that income from your investments. But with income also come taxes. So we want to make sure that you're not giving all of your hard-earned money to the IRS, to Uncle Sam. We want to make sure that you're able to utilize your income to enjoy your life as much as possible. One of the other major fears that people have in retirement is healthcare. And that doesn't mean necessarily, of course, you want to have insurance and you'll have Medicare at age 65. And you can look at those types of plans like supplements and advantage plans and things of that nature. But it's more so also making sure you know what to do if either you or your spouse or your loved one has a healthcare event, requires long-term care, has an unexpected medical event. We build those things into our plan so that we, not necessarily knowing that, we're setting up long-term care insurance. For people that have that, that's wonderful. But it's also knowing about where to pull from your investments should that occur, the most efficient way to do that. And I can tell you, working for the elder law firm, I did a lot of long-term care planning and a lot of Medicaid planning and things of that nature. And I can tell you firsthand from what I've seen over the years, how devastating that could be to someone's financial plan if they're not prepared for it. And so that's kind of one of my passions, is making sure that that's something that's addressed in plans. And then, of course, the 5th is legacy. Now, we want you to enjoy your money as long as possible. We want you to spend it all. And if that's what you want, and we'll help you figure out how to do that, basically. But some people want to make sure that they're leaving some money for either their family or charity. And so we, in our planning, also figure out how is that going to work and what is the most tax efficient way to do that. And also making sure that your beneficiaries aren't going to have issues, and they're able to access that money as quickly as possible. So that could be something as simple as setting up proper beneficiaries with contingents. Also making sure that estate planning documents are up to date and that things have been addressed in that nature as well. And to make sure not only if your estate planning documents are up to date, but if you have a trust, for example, we will help you make sure that your assets are, following your attorney direction as far as what needs to be titled in the trust, et cetera. So that's another very important part of it. And this is called our plan on purpose. And that kind of ties back into the fact that we want to make sure that your dollars have a purpose, and that will help reduce anxiety with market volatility.
Hey, Grace, real quick before you jump into this last slide, can you make me the host again so I can drop this link in the chat to everybody?
Zach is asking me to do very advanced things in Zoom, everybody.
Grace has it. She's a technology wizard.
I mentioned earlier that I'm in my 40s. We didn't have Zoom when I was growing up.
Hey, I'm in my 30s. I can say the same thing. We didn't have Zoom when I was growing up either.
Okay, Zach, I did
Perfect. Yep. All right. You can move ahead.
it. Okay. Oh, you'll have to move the slide for me now.
No, you still have slide control.
Oh yeah, okay, sorry. Okay, so let's talk. Are you a client that has a question? I'm here for you. Are you working with another advisor and you'd like a second opinion or an opinion on what's going on and really dial into, what's going on with your accounts and your portfolio? Are you currently evaluating working with a professional? We would love to talk to you about this, and really get personal and really be more dialed into what your particular scenario is. So if you'd like to do that, Zach is putting something in the chat, I believe.
Yep. The link that'll take you directly to this form has just been dropped in the chat. So yeah, like Grace said, if you're currently working with this, if you got a question for Grace or the team, or if you're not working with Reliance and you just like to have a conversation, maybe about something that was presented today, or you just want to learn a little bit more about what we do and who we serve, we'd love to have that conversation with you.
Yep. So that is all I have.
I think you did a fantastic job. I appreciate everybody taking the time out of their day to join us. Ideally, going forward, we're going to be doing at least one of these a month, hopefully more. So, Grace loved the opportunity to present today. So, just stay posted on our email distributions for future invites for live webinars. Love to have you here today, and we'll definitely see you more in the future as well.
And also, if there's a topic that you would like to see us cover here, I would love to know. So either drop it in the chat or email it to this, or go to that link and just make that comment in your message of anything that you'd like to see us cover, and we will try to make it happen for you. But I really appreciate everyone being here. Sorry about the technical slight issues, but I blame Zach.
Take the blame. Yeah, we appreciate all of you taking the time. Yeah, and if you have any questions, like we said, go to this link, fill out the form. But we'd also love to know, what do you want to hear about in the future? We'd love to do presentations on that. I see a couple popping in right now. Somebody wants to talk about pros and cons with annuities, alternative investments. So it's definitely something we could address potentially in the future.
All right. Well, thank you guys so much. I didn't get to see anybody, but I feel your presence.
Yeah, appreciate having all of you here. We'll talk to you soon.
All right. Thank you.